Bitcoin dumped below $90,000 again, leading many to use this as further evidence that the cycle top is obviously in and that the 4-year cycle is alive. And well, I would imagine that not all of today's guests agree with that sentiment. And of course, we have the Fed meeting last week, one of the most contentious Fed meetings we've seen in a long time. Absolutely no consensus on what to do. And Jerome Powell seeming very non-committal about what is happening moving forward. Also, we have a hell of a lot of news about tokenization. We are ready to go here for another Macro Monday with James, Dave, and Mike. Let's go.
Let's go.
Good morning, everybody, and welcome to yet another Macro Monday, which everybody who's anybody knows is the greatest hour of the week on planet Earth of all time ever. Going to bring on Dave, Mike, and James right now. Good morning, gentlemen. Mike, here we are coming into the end of the year. I've got to imagine that you've had some excitement in the morning meetings because there's no consensus on anything anywhere, seemingly.
Well, there you go. Anna pointed out the amount of data we get this week she's never seen in her lifetime. So just went through some of the data. I'll point out a little bit. CPI Thursday and November going to get partially CPI. Expects those numbers to be a little bit weaker. I think the number she was looking for CPI is 0.3%, and then CPI drifting up to 3.1% in November, but dropping next year. She pointed out there's the Goolsbee Price Index. It collects online data. Goolsbee's chairman of the Chicago Fed. Shows very large decline in goods prices, but then she pointed out healthcare should rise, core CPI, and I pointed out the core CPI number 0.3%. But the two payroll numbers are October and November, expecting a negative number for October. A lot of that's related to federal workers' deferred resignations. Seasonal adjustments will be significant, but what's unique this year, she pointed out, is this is the first time in 15 years we did not have a significant hurricane hit land in the U.S. Those of us who live in Florida kind of appreciate that, but having lived in Connecticut the last 30 years, that's where hurricanes go now. But that's so Sikin is pointing out for November payroll, she expects a strong number, 130,000 versus 50,000 consensus. So that's probably the most significant thing from the meeting. Consensus is 50, she's 130, but she expects employment rate to run for November between 4.6 and 4.7%. But some of that's technical factors, the government shutdown, disparity in responses, and she realistically says it probably should be closer to 4.4. But what it prints might be a bit of a distraction. Expecting payrolls to be weak in the next year, methodological changes, and core inflation to peak in 1Q26. And then she pointed out they did a whole big study. My colleague who sits right behind me, Josh Daniels, did a big AI scrape of earnings calls. I think there was like 17,000 of them, and came up with deflation significantly dropping in 2026. Jillian Wolf, our stocks person, pointed out large caps are bullish heading to 2026. Earnings are strong. Doesn't see a bubble brewing. Their market checklist is strong. Their only model that's negative is the economic regime model. Full steam ahead for earnings. Convergence from 493 versus Mag 7 next year, but does point out valuations are lofty, and she does think that bubble fears are overblown. Ira Jersey pointed out what's happening now is QE light. Now this, I thought of James when he said, I want James to respond on this later in the meeting, but the 40 billion of T-bill purchases next year has some unique things, and key fact is they'll be able to reduce coupon issuances, which means reducing coupons for 10s, 20s, and 30s is what he thinks is going to be happening. And as far as inflation, expects no uptick in inflation break-evens, and has been no uptick in inflation break-evens. And I came on and pointed out we have pretty decent signs of energy deflation kicking in. The average price of gasoline in this country has dropped below $3, running $2.90 at the moment. Natural gas, the #1 measure of heat, electricity, and fertilizer in this country, was running 2 weeks ago 5.5. Was heading close towards the end of the year, highest close since 2009, and right now it's 4. It's been hovering on 4 for a while. That's the January contract that expires in a couple days. Looks like it's going to it might hold form. Looks like it's going to break that support, and that's despite the winter coming in as a lion. It's going out as a lamb. Put it this way: in the Corn Belt last weekend, prices got down to 0 Fahrenheit, and by Christmas Eve, supposed to get up to near 67. So I'm pointing that key disparity, what's happening in all commodities, energy deflation, grain deflation, and the only thing that's being held up are metals, led by gold. Copper's still pretty strong, and that's why, to me, the burden of inflation next year in commodities is on copper. It has to go up. And the stock market just drops 10%. I think copper will drop 20%. Now, I ended with one key measure I wanted to point out, and made me think of you, Dave, and that is the lessons of the devil's metal. Silver. The last time we had a year like this in silver was, this year's 120%. It's leading everything. It's a great year. It's wonderful. The key thing I got wrong was that gold silver ratio. I wouldn't drop this much, but the key fact of silver is you never want to be overweight long silver on a buy-hold basis if the lessons of history are a guide when it gets this stretch. So it's the most stretch versus most moving averages, say 60-month, 30-month, 40-month, since that big run-up in the late 70s, early 80s. And I'll give you one example. 1979, the most significant year ever, silver rallied about 40% or 400%. It closed at $32.20. This year's low, almost 50 years later, was 28 bucks. That's a big difference with commodities. They don't give you income. Human ingenuity pushes prices lower, and you got to be careful. And then I went over to my Bitcoin thing. I think Bitcoin's peaked. I think it's heading lower. And I'm just watching that Bitcoin gold ratio, 20.69. I think at risk, it's more likely to go to 10 next year and then go above 30. Back to you.
Yes, I do want to talk about that in a minute, because that was part of Luke Groman's point that I know that everybody wanted to discuss. But Mike, you did, I think, tee up James there for a conversation that's worth having really quickly before we dive into Bitcoin. Obviously, we had the Fed meeting. Fed starts stealth easing. Powell rules out hike and markets rally. We had, if you really dig into the voting, it was completely mixed. If the individual bank heads had their votes, it would have been even more mixed. We had Miran basically saying 50 bips, but a lot of people saying we shouldn't have cut at all, and some saying we shouldn't cut at all for quite a long time. So I think that's worth discussing. But James, more specifically, QE, not QE, right? Because that's been the debate of the last 5 days, I think, is a lot of people getting tied up, I think, on the technical definition of what quantitative easing is and conflating that with whether that's some form of money printing or there are other kinds of easing. But maybe you can give us your take on whether the Fed buying treasury bills is QE or not.
Of course it is. I mean, in the traditional sense, let's back up. When people say QE, they think of money printing. They think of expansion of liquidity, right? Technically, QE is when the Fed goes out and purchases coupons. They purchase 7-year, 10-year, 20-year, 30-year treasuries and mortgage-backed securities. That's the technical term of it. So Twitter gets all wound up, and everybody's fighting about whether it's QE or not QE. It's just like, what's the definition? What are you trying to define? So when people say QE, they say quantitative easing, and they think money printing. So technically, no, it's not technically QE, but it is QE, not QE, So, and what does that mean? It means that they're injecting liquidity into the money supply. Yeah, they're buying T-bills, they're buying short-term treasuries, and they're allowing for the treasury to continue to issue short-term treasuries to fund a deficit. Deficits are technically just realistically, deficits are inflationary. We're running fiscal deficits. This is what we hear every single time we see that meme from Lynn Alden of nothing stops this train. She's talking about fiscal dominance. And so this is what it enables. So let's go back to first principles. You've got a Congress that won't stop spending, that is overspending every single year. We're running multi-trillion-dollar deficits, and you've got the Treasury that's enabling that. It's not the Treasury's fault. The Treasury is trying to do everything they can to manage the budget that Congress gives them. And Congress gives them a budget that's way, way, way over the amount that we take in on taxes and fees and any other revenues that we get for the government. And so you're running multi-trillion-dollar deficits. You've got to keep issuing debt. So because we have high interest rates right now, historically over the last 20 years, they've been high, over 4%. The Treasury has been playing chicken with the Fed, meaning that Bissett, before coming into office, was highly critical of Yellen because she didn't term out the debt. She didn't move some of the obligations of the US government out and lock in lower rates before the Fed raised their rates. And so that was, he was highly critical of it. And we expected, everybody expected that once the Fed started lowering rates right before the election back over a year ago, they would keep lowering rates. It's typically what they do. They don't just lower 50 basis points and stop. Well, they stopped. And so now you've got Bissett out there who's been frustrated and this current administration because the Fed stopped lowering rates. And they expected them to lower rates where they could term out the debt a little bit, but they haven't been able to. So now they've been adding more and more and more and more US T-bills as a percentage of total debt. So where is the Fed going to come in and help liquidity of banks? Well, the bank reserves have gotten low enough that now they're ample. They're in that ample zone, and it starts to give them a little bit of nervousness. That nervousness has been it's accelerated because at the month end of October, November, you saw spikes in the need for liquidity from the banks. They went into the repo market and they were actually using the Fed's overnight window and the standing repo facility. Now that's highly unusual. Why is that highly unusual? Because banks don't like to borrow from the Fed. Why do they not like to borrow from the Fed? Because it's seen as a weakness. And so it's got a negative stigma to it if you go and use the Fed window. Yet they used it. They used it to the tune of $50 billion at the end of October, which was kind of a wake-up call that, oh my God, SOFR rate spiked, meaning the overnight rate that banks charge each other to borrow from each other spiked. So now the Fed's on alert because they know that there's need for liquidity out there. They want the banks to come to them, and they're trying to take away that negative stigma and make it normalized to use their overnight facility. But they're realizing that they've got to get more liquidity out there because at this point, you're going to see spikes in the SOFR rate, and exactly what happened in 2019 will happen again. Because when the reserves of the bank get low enough, they've already drawn all the money out of the reverse repo by issuing all these T-bills. There's none of that left. So now where do they go? They need more liquidity. They're issuing T-bills. So the Fed's going to go out and say, you know what, we'll buy some T-bills. We're going to buy $40 billion worth in this next month to start this program going. And then they're going to be out there and continuously buying T-bills to enable this liquidity. So you tell me, money is going into the market, whether it's in long-term bills or long-term bonds or short-term bills. You tell me, is that money printing or not? To me, it's just semantics, whether or not you call it QE or you call it, not QE, or what is the term that they're using this on this go around. Whatever it is, they're adding liquidity to the market, and that's simply what it is. So you can call it QE or not QE, but it's the liquidity addition. It's just first principles in my mind.
I agree. And Dave, on the FOMC side, I mean, you can obviously comment on what they're saying, but I do.
They're calling it reserve management, by the way.
Yeah,
that's what we knew, that they were going to call it something silly. Yeah, but anyways,
reserves by adding money. Easy. Yeah. Go ahead, Dave.
Yeah, it's funny. I have two totally separate questions, both relate to the same topic. The first was a story that I don't know if you have it, Scott, handy, but the presumptive, or at least the polymarket presumptive next Fed chair going on. What was it? Let's see which one. Where was it? On Face the Nation was Hassett saying that budget deficit's going to fall in 2026, $600 billion. I'm curious what you think about that. I mean, if it turned, of course, there's no evidence to indicate that he's right, but let's say it is true, then I guess that means less money printing, still, well over $1 trillion in peacetime with an expanding economy, which is definitely inflationary, but everything's relative. And then the other thesis that, and I'm curious what you think about that, or is that just political posturing? And then the other question was this notion that AI that the big firms are borrowing so much money in order to invest in AI infrastructure that is not yet productive, that it's becoming a liquidity sink, as it were, which is, instead of liquidity rippling throughout the economy, they're drowning out or crowding out what might be go into assets or more short-term productive resources. I tend to think that that's kind of a silly way of looking at it, namely
Yeah, but
because
where's debt come from?
well,
I mean,
the
debt,
point is, yeah,
the
exactly.
debt comes from money printing. I mean, the banks are giving that they're literally printing money to give to them to, that's the definition of that's fractional banking.
No, I get that. I'm just saying, but those are the two narratives that have come up over the weekend of people saying, well, it's sound money. I mean, look, at the end of the day, all of this is fascinating because you and I both think that Bitcoin should and eventually will move relative to its highest correlation will be toward the fiat debasement trade. Yet the cycle bros and people like Luke Roman included are confusing short-term correlation with causation, right? They're saying Bitcoin is actually a tech stock, which to me is amusing because we all understand that, tech stocks have adoption cycles, that Bitcoin has an adoption cycle. That is absolutely true. Its sole similarity to a tech stock is it, like Meta or to some degree Google in its early days, is absolutely, one looks at adoption as being relevant, right? I mean, we all kind of understand network effects, but unlike them, it's pure network effect, and you look at the network, etc., and it's amusing because they ignore the fact that in a tech stock you're looking at earnings and margins, etc., and in Bitcoin what you're looking at is it's pure adoption or no adoption. I always use the option framing, but it doesn't really matter. The fact is that's the narrative that's being sold to investors, and you can dispute it if you'd like, and that's totally fine. But most of the people who are buy and holding believe that. The people who are trading, on the other hand, trade based off of whatever the hell they're going to trade off of. I would say most traders use recent correlation as their bellwether, right?
I mean, look, let's face it. There is an aspect to Bitcoin, especially in its adoption phase here, that is that likens it to a tech stock, and there's just no way around it. It's like trading the Qs. But there's a few reasons for that. Misunderstanding it, it's early in its adoption. There's a lot of demand for it that moves the price around. If you're a hedge fund, you're not trading fart coin. You're going to trade Bitcoin. You're not. And so this is the asset that they can really move around. That's one thing. Michael Howell had a great piece out this weekend that talked about Bitcoin in specific, and how he's actually flipped. He's on the other side of Luke Groman today, where he's like, we're buying the dips. And the reason they're buying the dips is because he sees it as about a third, tech stock, and about 2/3 of a commodity like gold or silver. And so, yes, it does have short-term moves. Absolutely. It has short-term moves that seem to correlate pretty heavily ahead of the Q moves, because it's kind of the tip of the risk spear, so to speak. But overall, if you look at long term, it absolutely correlates to the expansion of liquidity, not necessarily M2, but all of liquidity, global liquidity. And so the question is, where are we going with global liquidity? Well, you've got the Fed and the Bank of China that are going to be easing into this next year. It's a completely different cycle than the rest of the world. You've got the two largest central banks in the world that are easing, as you've got a recovery happening in the rest of the world, and Europe is starting to tighten because of recovery. So it's an interesting dynamic, but which way do you come out on? I come out on that we're going to see an expansion of liquidity, and it's not just money supply, it's total liquidity, like we were just talking about.
So the one bank that you didn't mention, the third largest economy or the third most important central bank, is something that has to get talked about. Mike, I'm curious. I was actually stunned that you didn't mention Japan in the morning meeting,
right?
Because that's quite literally the big macro story of the week. So, maybe that was an oversight, or maybe it just deserves its own special segment. But with the Bank of Japan, set to boost interest rates, there are so many macro pundits in the KOL space in crypto saying that we're going to get a crash later this week when this happens. Now, I'm not going to even try to hide my disdain for people.
I want to hear what Mike has to say about it, but I've got an
very
opinion
curious
too.
what you think about that. I mean, for just for context for people following along at home, the Japanese government bond 10-year yield has doubled in 2025, literally doubled. It's pushing towards 2%. It's almost to the point where it's quote normalized with Germany, which is, if someone had told, I'm pretty confident that nobody predicted that would happen in January as one of their 2025 theses. Yet that's exactly where we are. And now the Bank of Japan is getting set to hike rates again. They've telegraphed it quite well. So I'm curious, what do you think that means from the global liquidity perspective? We know that this is in reaction to the government doing fiscal stimulus, right? That we know. That's not in dispute. And what we also know, and a lot of people don't appreciate, and here I'm gonna shut up and let you talk now. But people don't appreciate is Japan has one of the most, if not the most, fastest aging population out there, and therefore consumer inflation is a death sentence for any politician. And so that's why the central bank's doing what they're doing. So they're doing these fiscal and monetary policies that are banging, fiscally, let's stimulate, monetary, okay, wait a minute, we got to tap the brakes. So curious, I mean, what are your macro analysts talking about Japan? What do you think happens this week? And, is it a big deal? Because from a carry trade perspective, the yen is not moving. I mean, it's stable within its small range. I mean, if anything, it's slightly strengthened. And that's really the biggest deal. And the interest rates are what they are. They have been moving this way. And once again, there's no trigger to cause like a mass panic. But I am curious what your analysts are saying about Japan.
This morning, our FX strategy, Audrey Childe-Friedman, was out. We had another strategist who focused on LATAM. So that's why I didn't mention Japan. But the key thing I want to point out is those of us who traded Japanese government bonds 3 decades ago, we're later stages of the end of a severe deflationary cycles that's just starting to reflate a little. It took almost 4 decades, 3 decades. And I want to tilt over to really what matters now. And I'll share my screen and show a few things. Now, yeah, Japan matters. Its two-year yield, 10-year bond is like 2%. But let's look at the latest headline from China. China is in a severe deflationary cycle similar to Japan 3 decades ago. And this is just the latest headline. China's consumer frailty leaves economy exposed to trade jitters. Now, this is after they had pretty significant stimulus this year to get consumers to spend, still not working. And there's another headline from my colleague that hit this weekend. Easing party in 2026, some asset, Japan obviously, global central bank outlook. And now that fits with your outlook of liquidity being pumped, but you're missing what to buy. The US just announced, the biggest central bank on the planet just announced they're going to start buying T-bills. Now in baseball, they say it always starts with the walk. They're going to get to the bond market. I think it's a matter of time as everything heads lower, like we're heading in Japan right now. And the last thing you want to buy, I think, is a highly volatile speculative risk asset with unlimited supply, which is Bitcoin. And that's the problem. I think that's what's kicking in. That's why I'm still very bearish this space. And I'll point out one reason. I've been using this date, 1929, for a while. We'll just take the Bloomberg Galaxy Crypto Index, overlay it with the S&P 500, 1929. It's almost the exact same chart. It wasn't such a bad year for S&P 500 in 1929. Ended up down, 12%? And Bitcoin, Bloomberg Galaxy Crypto Index is right now down 15%. I'm worried about, and why do I go back to that date? Well, you have to go back to the last time we had U.S. stock market captive GDP at this level was on an annual basis was 1928. Now, our stock market versus rest of the world has started tilting lower. The key thing I like to watch is this has been completely coordinated with, coincident with that Bitcoin, the gold ratio popping up. And now it's dropping, like I said, 21. I think it's going to go to 10 next year. I don't think that's a big difference. And I also look at one key thing is a number you have to have in mind for Bitcoin this year is 59,000. If we end the year above 59,000, it'll be the narrowest range ever in Bitcoin. The narrowest ever was 36% or so in 2015. Now we've had most drops are down much more than that. Most rallies much more than that. So obviously we're heading lower. If we don't end down the year 36%, which would be around 59,000, would be the nearest range ever. That's on the back of what's happening with ETFs. The world is just, Bitcoin is no longer the asset you want to buy that's going to give you the vig. That trade is over, in my view. And then I look over, and this is just the world bond markets, what we were talking about earlier. This is the one that matters. It's China, 1.85. Now it's ticked up this year, but severe deflationary forces in that country that has debt to GDP running 300%. In this country, we're still in 100% range. We're going to go higher. And money supply running 45 to 50 trillion dollars, is almost double the US. So that's the one that matters. I think obviously that yen keeps declining versus the US, it's going to matter, but it's the macro is, this is just starting to tilt lower. And I just want to show you two key things that have really kicking in the US. We're seeing deflation in gasoline prices. Trump's going to get that right. And deflation in natural gas prices. Just about matter to break down. The only thing that's been going up, really major thing, is gold. And I'm really worried about gold.
That Bitcoin gold ratio has become a major narrative. Obviously, we had the endless debate about it here. Dave and Mike, you guys made a bet about which would outperform over a year. Gold has obviously been absolutely flying. I want to go back because we've mentioned him a few times.
Well, hold on a second. Before we go there, hold on. Let's go back to Dave's question first, and then let's get to this. There's so much to unpack with what sure. Mike just said. But first, Dave's question about Japan. And the reality is the Japan carry trade is over. It's not going to blow up. It is over. Like it was over on August 8th in 2024 when the market crashed from it because the Japanese central bank lost control of the short end of the curve. They couldn't, or of their tenure, they couldn't hold it down anymore. And so that's not a danger that suddenly trillions of dollars are gonna come out of the market. The era of free money out of Japan is over. You're watching. I mildly disagree with Mike in that your point is that you're seeing finally after 4 decades reinflation. I think we're witnessing the death of a currency. That's what we're witnessing. It's not just reinflation. We're literally witnessing the death of a currency. And why are we witnessing that? The Japanese government owns more JGBs than any other entity in the world. They own over 50% of their own bonds. Like they are literally dying. And it's not just the currency. And part of the reason is that because their demographic is dying. They have a very old demographic, like you pointed out, Dave. And so they are struggling to stimulate the economy. They finally have stimulated it, and now they're in a position where they're going to have to keep printing money ad nauseum in infinitum, ad infinitum, and that's just the reality. And you're watching it in slow motion. It's going to die. I don't know when, but this is a problem. But the reality is, for the rest of the world, is that you have the era of free money coming out of Japan is over. So where are they going to stimulate next? It's like their turn is done. Now they've got to do it somewhere else because it's not like governments are going to stop spending. You're seeing it across the world. So it's now China's turn and the US's turn, just like you pointed out, Mike, that China has to print, and they're going to have to stimulate the economy. That's just reality. So now we can go back to the gold conversation and where you were going with that, Scott. But that, just to answer your question, I don't think that Bitcoin is going to crash because of Japanese, the Japan interest rates.
Yeah, not only is it over, we had that narrative a year ago that
it's all priced in. Japan is priced in.
Nobody's jumped back into that, but I want to talk about Luke Roman here. Mike,
sorry, Scott. One other thing. I know Japan is, because Japan's actually a big topic. There's one other piece of news that is relevant. The Japanese Japanese Bank of Japan announced that they're going to be divesting on a schedule from ETF purchases. Basically, in the skeptical person would say to give them more room to be able to buy their bonds. But they've actually done things like they bought stocks. They've actually made money by supporting the Japanese stock market. And I think it's important to understand that they've been the most manipulative of all the central banks in terms of, and I'm using the word manipulative because if anybody else did what the central banks do, which is buy assets with the specific intent of pushing the price up for no particular other reason than that, they'd be called manipulators. And that's what the Bank of Japan did. I think that's relevant here. And I think there are people who actually made the idiotic assessment that they have ETF, that the Japanese bank owns Bitcoin ETFs for some reason. I can't imagine where they come up with that, because they don't.
No, because they're fully in Metaplanet and Fartcoin. No, but yeah.
Yeah. Anyway, the point is, just to put a bow on it, I mean, it's a space that needs to be watched, because it is a major engine of global liquidity. If they're going to be selling, in all likelihood, they're going to use those funds for something. But it is on a schedule. It's not smash selling. It's nothing crazy, but it is something to keep an eye on. And I'm sorry to interrupt, but I just wanted to make sure.
Fine. So going to what Luke Roman said, because I think it's been a good catalyst for a lot of conversation. Obviously, Luke is a massive Bitcoiner, and anytime a massive Bitcoiner, I guess we can call it, capitulates, it raises the spidey senses all over crypto Twitter. But this is why he said he basically lightened, seemingly, he said reduced, but when you hear him talk, it sounds like he kind of just exited. But because of risk of quantum computing, I mean, if you're selling your Bitcoin today because of the risk of quantum computing, I have a bridge to sell for you, to you on the moon. But not making new highs versus gold, that's been one of the big narratives, and that was what I wanted to talk about there. Lots of selling from whales. Okay. Charts broke down 6 weeks ago. That part is extremely accurate. As I've pointed out many times, the weekly 50 MA broke down. That has never broken down in a bull market. It has always visited the 200, which is at 56,000 right now, and believes 4-year cycle is playing out. Mike, a lot of this echoes your points, but from a guy who's been pretty much a diehard Bitcoiner.
It's a bald guy bond, I think. Maybe Luke has got the better hair. And I got to throw a few charts, and I push back on some of you sometimes, Dave and Scott, and sometimes we use the word crash when I say I think the stock market's going down. I want to use the word crash today. I think we're heading towards a potential crash, potentially within the next few days. So first, I show here's a chart in NVIDIA. That looks like a pretty good head and shoulders top, despite the fact we had all that data, S&P 500 making new high last week. And then let's look at Microsoft. There's a nice, perfect little double top there. Everything's tilting lower. And I want to remind everybody what happened with the stock market, S&P 500. The last 3 weeks of 2024 dropped about 5%. And that high lasted until like June. That everything was heading higher then, but now everything's heading lower. The 200-day moving average of Bitcoin, for one, is heading lower. All these things are having problems, and it's that time of year. And now we have all this data dump. I think we're just going to do, the crypto markets are leading us to what's going to happen. People are just saying, thank you, great profits. Your rational investors said, all right, let's just start taking some of those profits. And I think it's going to cascade potentially into the end of the year. It's just all pointing that way. And the number one leading indicator is Bitcoin. So Bitcoin again broke down below 90 this weekend. It held at 88. But to me, yeah, I'm predicting there's a potential for a crash here. Certainly in the next couple weeks. We're not supposed to do that, but that's why it's all happening. And I just point out, here's things pointing that way. I just loved it. And I point out this still that, go ahead.
It's a good point, Mark. I don't disagree that we have a potential crash in the general market. I mean, the consolidated, like, it is so top heavy in just a few names, and like you just pointed out on NVIDIA, like we don't the accounting treatment of and how they are like the debt that they are taking on, and then they're lending out money for companies to buy chips. Like, this is just it's complicated, and it can get investors nervous, even if there is a long-term obviously a extraordinarily bullish case for AI. Short term, you could easily have a crash, and we've been watching for that in my hedge fund, and we've been hedging for that just in case. And the reality is, though, Bitcoin's already dropped 30%. Would it drop more? Yeah, it would. Would it crash another 60%? I would be extremely cautious against that. I do not expect that. Could it crash another 10, 20%? Yeah, easily. That's just one of the things that Bitcoin can do. So if you have a general drawdown in the overall market, it could. That doesn't mean it's going to. But overall, the going back to first principles and longer term view is that they're going to keep printing money. The liquidity is going to expand. And I think in 2026, you're going to see an expansion there. And you could see Mike, this is the one thing that partially keeps me up at night, is you could see this market just keep ripping higher. Like this could end up just, being a blow off top that we haven't seen before. Is it possible? Yeah. I would caution, just like you, that the market is top heavy. It's just reality. What does that mean? Well, you have to stay exposed in some way, shape, or form, because you're going to have an expansion and debasement of your currency. It's just reality. It's
So
just
that's
a
what
question of how you do it short term, and whether or not you get out completely. Like you're talking, like Luke Groman is now in just gold. And remember, Luke is very focused on an institutional investor base. So I understand where he's
I
coming
assume when
from.
you said you were hedging for your hedge fund and preparing, it meant you bought all of Luke Groman's Bitcoin.
We're still fully exposed. We're on a Bitcoin standard, but I do have hedges around it because of exactly the things that Mike is talking about. But we remain exposed. That's
Dave,
the
you
point.
said
Is that if Bitcoin goes up, we are going to do very well. What's that?
Yeah. Dave said he capitulated, right? This is what capitulation looks like. Dave, you put it in pretty simple terms there.
Yeah, I mean, it's undeniable. I mean, if you look at his reasons, I mean, go through his reasons. Quantum. The one thing we know about quantum computing, there is literally almost zero risk unless the Bitcoin core developers fall asleep at the switch and all commit collective harry-carry. The only real risk, and I say it this way because people need to understand this, are those wallets that have exposed public keys that can't be changed, which is about 4 million coins, much of which is part of the lost supply of Bitcoin. So about half lost, half the Satoshi and other old wallets. Okay. So now ask yourself a question. What happens to the price of a corporate asset or any other asset of a similar size if we're talking 20%, not 20%. If you're talking, well, I mean, 20% of the asset, it's a little bit less than that.
Yeah, if you go to the 2 million.
Is unlocked. Is unlocked from insiders. We have lots of experience of this. It is not devastating. It is negative. It is an overhang that matters. So understand that this notion of Bitcoin crashing because 20% of its supply gets unlocked is predicated upon a foolish assumption, a completely foolish assumption, which is that whoever steals these Bitcoin, and steal is be a relative term. I mean, some of it is lost and they're basically just going to find it. And yeah, there'll be court cases about it, etc. if it was in the US, but chances are it won't be in the US. It'll be outside of it. Now you have people who have hacked and created with their massive expenditures in quantum computing, extreme wealth. Are they going to say, you know what? I created this extreme wealth. I'm going to destroy it. Of course not. What they're going to do is they're going to try to monetize it. What's the best way to do that? That's going to be treat it like it's an asset that they actually own, and they're going to sell it slowly and obfuscate it. It'll end up spread out over hundreds of thousands of quantum resistant wallets with no exposed public keys so that people can't get it. Because if you're smart enough to hack, that's what you're going to do. And think about it, because essentially what's going to happen with Bitcoin is all of us right now, if I told people my public address in order to collect donations, believe me, the instant anything hit that, it would be getting moved to another address that I know and nobody else has the public key, because that's what's going to happen with Bitcoin. There'll be there, and we talk with Yago, we talk with lots of people, Scott, you and I. There are lots of people working on technology to obfuscate. So that will happen. Now, why would anybody think that the smartest people on the planet capable of creating quantum computing at multiple orders of magnitude faster than it is today, which is still not remotely close to being demonstrated, are going to do anything different? And so what I'm trying to say is that the threat to this, it's not that it's overblown, it's that it's not understood. That people are making all
He even said he didn't understand it, by the way. He literally, that was the one he kind of mumbled through in the interview. He was like, I don't really understand quantum.
Exactly. So he
like,
completely ignores it. But I want to make it clear, because that is the only one on his list that has any veracity whatsoever. Everything else is breaking the first rule of statistics. The first rule of statistics is don't confuse correlation with causation. And he, everything on his list is breaking that. And the only way you get there as a fundamental investor by now looking at short-term price action is by basically implying causation when it's only correlation. And that is just dumb. It's fine for a trader to do that in the short run. But if you're making a long-term call on the basis of that, that's capitulation. That's literally the textbook definition. That's saying, I'm sick of this shit. The price is not done what I expected to. He literally said, and I'm sorry, Luke, because if you're watching this, I would love to do a one-on-one with you, but you literally at the same time said the 4-year cycle is intact, but it didn't rally because of what we saw versus gold, which is a point I've been jumping up and down on. This is not a 4-year cycle because there was no bull run. Because measured in the thing that Bitcoiners most think it should be measured against, it didn't go up. And so that matters. And so those two things are contradictory. So yes, this is I'm tired of this shit. I want to be out. I'm going to go do this. Now, the problem is in the world of trading, when you get to that point, that's generally the worst time to sell. Maybe not the worst time, but Mike and I have one disagreement that is we have disagree on two things that have come up on this show. We disagree, number one, on a factual matter. Every time he says Bitcoin has unlimited supply, I want to slap him his head like Benny Hill used to do to the little bald guy, because it's just
Great
wrong. Right? It's just Bitcoin does not have unlimited supply. Bitcoin has a 4 million Bitcoin supply overhang from quantum, maybe at some point in the next decade or two. But other than that, its supply is fixed, and we understand that. So let's just get past that. I don't want to hear about Fartcoin and, God forbid, all the coins on pump.fun being considered Bitcoin competitors. They're not. They compete with it no differently than a penny stock competes with NVIDIA. There's no difference there. But okay. The second thing we disagree on is I'm more bullish than Mike is on gold and silver, because I don't think that the rally is nearly as out of place and stretched, because I'm looking at it with the denominator. If you consider that the US dollar has double the amount in existence it did 5 years ago, then you literally have to divide the price of gold by 50% to be a real term, not nominal term. And in that particular case, it looks like it's been a healthy rally, but not remotely extended, which is why I think you could see 5,000 plus in gold and you could see 75 plus in silver. And I'm going to continue to reiterate that call every week until it either happens or they break. And I've been saying it, pretty consistently. So those are the two places we disagree. But the problem that I have with that is if you're looking at Bitcoin in the same way, Bitcoin is down this year. It's not the fourth year of a bull cycle. It had a rally based on a political change. That's it. Literally. It did not have anything fundamental. It was a step function. It almost was a reprice up by double.
And it definitely got ahead of itself
and changed it. And
so
yeah, exactly. And that now, but for the last few months, if you look at it compared to its network, it's way behind itself. And so the only thing that would change my view is people who say
lower
the
prices.
Bitcoin network is running. No, not lower prices. The Bitcoin network.
I'm firing you up, Dave. It's fun.
Watch the network and watch what's going on. Because if the network, in fact, goes from over 115 to 100 down to 50, yeah, I think Bitcoin could drop significantly.
So let's keep it simple. I have one theory here, and that is last year at this time, the government was supposed to be buying Bitcoin. And now we know for a fact they're starting to buy treasuries. I stick with what the central bank's doing, is buying treasuries. Now, we all know one of the best reasons to buy gold for the last 5 years was central banks are buying gold. But let's remember the pain that needs to be necessary. In 21, 22, and 23, McGlone was adamant gold's going to go above 2,000. I just finally got frustrated. I was basically wrong, and finally it did. To me, that trade's over. I mean, that's the way you got to have the pain for the gain. But now, I have to show you this chart.
Wait. You think the gold trade is over?
Oh yeah. The mass. Why not? The gold taking after alpha this year to me implies next year is beta goes down, and a lot potentially, and it's potentially going to start in the next couple of weeks. And so I think the majority of the best for silver too. You could from silver you could easily jump. I pointed out the first standard deviation move is 30%. It can get to, easily get towards 75. It can easily go back down to 40 if history is a guide. The vast majority of the velocity and gold rally here is over. When you've been bullish it forever and it breaks out this level, prudent risk management, money management says you're not supposed to overweight gold. You're supposed to say thank you. To me, the next big trade is starting to kick in, and government's telling you we're buying treasuries, we ain't buying gold, and that's why I have to tilt over to my Bitcoin chart. It should easily get to 50,000. And potentially in the next month or two, and then 10,000 is nothing on the big picture chart. When people say take a look at the chart, and here's one key thing I didn't point on this chart that hasn't happened since 2017, which was very precursor for a decline in 2018. This is 120-day volatility S&P 500. It's the lowest at the end of year basis since 2017. Good luck. This risk asset is going down, and yes, there is a complete unlimited supply of cryptocurrencies, and this is quoting Scott. Humans will human. Humans have human in this space. Bitcoin was one. It was the first in 2009. It's great. It has that benefit. We all know in technology sometimes it's not best to be first, and now there's so many better Bitcoins out there according to the people who create them. The point is, now I think the institutions are getting poor performance, high volatility. President Trump's on board and pushing a lot of hype. Get me out, buy something that's less hyped. Okay, gold was, and it's already moved. What's the government, central bank starting to do? Buy treasuries? I say stick with the central bank. Buy treasuries.
There is nobody who's saying they've built a better Bitcoin, Mike.
Oh, I've heard of my
maybe the 12 people who are lost.
Well, I mean, of course, the XRP army is, and Zcash, but that's they're pumping their bags.
Okay, I don't think
everybody is.
I don't even think they're saying they built a better Bitcoin. By the way, I just think that they're saying their thing might be a better investment for various reasons.
There you go. Well, I've heard it on different podcasts, but the bottom line is there are 4 precious metals. They were great. I still stick with them long term, and there's multi-millions of cryptocurrencies. Bitcoin was first. Let's point out the facts here. There are astute people who are not really dug in this space are getting it. Root Gorman has flipped. Obviously, I was early last year, and I'm just looking for a classic purge. And I know, Dave, you don't like to hear about things like Dogecoin and Shiba Inu, but they've lost like 75% of their value from last year's peak. I think they're going to lose another 90%, pull the whole space down, and Bitcoin's one of them. And what we saw, though, is a lot of OGs who don't want to take the risk of having to lose their coins or being stolen or anything, have switched over to ETFs. But also the people who bought the ETFs were from the equity side and realizing, this trade's probably over. My performance is poor. If I had any type of equities, even leverage, I'm doing much better with lower risk. Why should I touch this space? And that's why, to me, the lower prices are going to bring out more lower prices.
Really quick, James.
Let's talk about that for a second. Let's talk about this just for a second, Scott. Let's talk about, because this was also on Twitter. People are talking about this. Is our OGs selling calls, does that have a negative effect on the price of Bitcoin? Let's just walk through it for people to understand what that math is. Okay, so you're an OG, you've got your thousands of coins, you want some yield on your Bitcoin, you don't want to be selling your Bitcoin, so what do? You sell out of the money calls. What are you doing? You're capturing volatility. Okay, so meaning that you're creating some sort of yield for yourself by selling out of the money calls. This is important to what you're talking about, Mike, and the OGs selling. OGs have obviously sold a lot of coins. They sold coins to get into ETFs to be able to borrow from them from the banks and use a balance sheet for margin. And then they also were selling them to get into Bitcoin treasury plays. But also, selling calls. It's a strategy. You sell calls. You receive the premium, you receive the theta for that, and a little bit of the beta for that. And so, but when you do that, what happens? Who's buying those? Who's buying those calls from you? Usually,
the option market maker. Yeah, he's buying the hedge.
Yes, the market maker is now long a call. So how are they going to hedge that? They're going to short Bitcoin against it in a delta hedge. It's not a full hedge, but it's a delta hedge. It means that it's a partial hedge against that Bitcoin that they're short via the call. And so it does have a negative pressure on Bitcoin. It is true. Is it all the pressure? No. Can it have negative pressure? Of course it can. That's the effect of partially selling your Bitcoin, is basically what's happening. If you're selling calls, you're partially selling your Bitcoin because you're laddering out. If Bitcoin rises to that level, you're out. And so the market maker has to hedge against that. Okay, you're out of that amount that you've hedged up.
Yeah, I just want to
So
very quickly say, okay, finish that.
that's the math of it. So no, it's not all of it, but it can absolutely have a negative effect on it. Yeah.
Yeah, I fundamentally disagree, Mike, with a couple things that you said. And one of them, and I think it's very important to be clear on, Dogecoin and Shiba Inu coming down do not drag the price of Bitcoin down. It works the opposite way. If Bitcoin
Well, I
goes
wish you
down,
luck with that one.
altcoins exit. I'm just saying, I do not think that there's, especially in the new institutionalized world where Bitcoin is largely available to everyone, if Dogecoin goes down 50%, I do not think that in any way affects the price of Bitcoin. I do not think that altcoins have been a drag on Bitcoin. I think Bitcoin not having its big 2025 have been a drag on altcoins.
So they're all going down together at the moment. So that right now the facts will prove you wrong.
They are absolutely
Mark, okay, well,
correlation causation once again there for
yeah, that is just hysterical. I mean, you know, so over the last 30 days, Bitcoin is down what, 8%? You know, whatever. Fartcoin, let's get it specifically because I used to look at it all the time. Fartcoin is down over the last 30 days. Where are we? It's way down. Oh,
so we'll just point out the Bloomberg Galaxy Crypto Index is down 15% on the year. It was up almost 28%. The whole space is going lower. Bitcoin's one of them. I know it's different. I get it. It's first. I'm just pointing out the whole space is going to continue going lower next year and maybe a lot.
That very well may be true. I just don't think it's, if Bitcoin goes down, it's going to be because altcoins went down. They've become such
they're all connected.
Yeah, I mean, I was just trying to get the actual data just to make the point. You know, where are we? Where's 1 month? So Fartcoin is I can't. It's weird because it dropped before the last month, but whatever. Anyway, you go back year to date. It is what it is. There are multiple important points here. I don't want to get into this is a macro show, so I don't want to get into this. You know, the flawed assumptions behind it, but it's true. I made the point that Bitcoin 10,000 mean it's broken. I finally, after a year, have gotten you to admit, and you maybe you didn't mean to admit it, but you did, that that Bitcoin 10,000 means that people think there's a better Bitcoin and it will lose its position as an incipient or growing global monetary asset. Those were your words when you talked about competitors. And so to me, that's what that means. I'm not saying can't happen, because it absolutely can happen. The market is not pricing Bitcoin at the same price as gold or the same price as 80% of gold. The market is pricing it dramatically lower, more correlated to the tech stock. So yes, anyone who says Bitcoin cannot fail, has reached escape velocity, is lying. It can fail. Now, do I think it will fail? No. Do I think that it is dramatically the market is dramatically mispricing it relative to its risk and all of the news and everything that's gone on fundamentally apart from price? Yes. That's where we differ. Now, the biggest difference in terms of looking at price, however, you know, with Bitcoin is its network and all the various things going on. And the point that I wanted to make here is we keep ignoring a simple fact about gold and silver, which is that it is enormously easy to speculate in gold and silver outside of the United States right now. And it's easy to do it if you're in the United States, if you're an institution. It's just individuals, unless you have what do you call it, interactive brokers account. Futures are harder for individuals to use, right? And so as a result, gold and silver have seen massive increases in speculative activity, which is amplifying all of the various things going on. That is why, by the way, crypto is dramatically less speculative. We see it in numbers all around the thing in terms of, you see it in Google searches.
Completely wrong.
Completely wrong. Crypto is less speculative.
It's the most speculative asset class I've seen in my entire career, and I started speculating in treasury futures in 1988.
But
now we have
space is about buy, sell, speculation.
Not my point. My point is relative. If you go back a year ago, 2 years ago, 3 years ago, 5 years ago, any period of time, the amount of speculation in crypto relative to the amount of speculation elsewhere is at a lower percentage. Doesn't mean it isn't a speculative asset. I'm not saying that. I'm saying that relatively the interest, people are people are interested in the shiny new object. And right now, Bitcoin has interest institutionally, but its volatility is lower for the reasons that James was mentioning. Jeff Park wrote a great article about this, but there is lots of speculation going on in lots of other places. And, and so the interest is less. So and that is signifying, that is not what it looks like at tops. It just isn't. Tops look like people are all bullish, all speculating, all piling in, and there's not a lot of that. We are in a
You
race.
just described 2025 in cryptocurrencies, maybe a couple months ago. That was my call last year. I stick with it. My call next year is we're going to see deflation starting to kick in. And maybe this week, let's put it in the micro. Bitcoin breaking down below 84,000 means the next level is around 50. Everything follows it. Stock market going with it. Bond yields going down. Maybe we'll get lucky and end strong, but that means next year we have a tilt that way. Remember, this is a complete difference from last year. Now, I also have to say these are some of my base views I was way early on a year ago, and now they're starting to accelerate. So I just hate to point out is certainly as a strategist with no vested interest, which is a difference from all of us. It's my duty to warn people. I do see a potential crash coming, and it started in cryptos. It's only 15% down this year. Not a bad deal. Whereas the next 15% in crypto index, maybe 20%. It's easily, I think, down rather than up. It's not that complicated.
I don't think it's fair to say the next level is 50. I mean, there's some glaring levels in between. 75, I think, is the most glaring level on the chart between there.
Look, I think that the 4-year cycle theory basically says that 80 should be tissue paper. It should have sliced through it. Meanwhile, we're still almost exactly in the middle of the range. And the thing you need to understand about ranges is when you have lots of call selling, it reinforces that range. But, and there's a huge but here, when you have a lot of call selling, and that is what's keeping a lid on overhead supply, the problem is if it breaks on the upside, it's called a gamma squeeze.
Exactly.
And
we had
all
that.
The market makers have to do that. And you could say that was what took us to 126, and I think that'd probably be accurate. I'd say that, going from the mid hundreds, which it was pretty solid for a while, up to 126 was a gamma squeeze. And then it stopped because there was enough selling to meet it and there was no bid. And so it went back down to where we are today. And we understand this because the entire crypto world, I mean, the vast majority believe that we had this bull market, which now means we have to have a bear market. Now, the amplitude of the bull market was way less. Even in nominal terms, it was way less.
Exactly. And the timing and what happened last year, I don't have to repeat everything, but you remember I said I thought it was peak Bitcoin, and now it's part of the bear market that's just getting started. Key thing part of that is I think next year, okay, I'll put out a view, it'll be the third down year for the S&P 500 since 2008. We're way overdue for it in total return basis. The whole thing's tilting that way. And what emboldens me to do that, when gold takes alpha, I worry, and I think you should start worrying too, and just panic. Maybe it's time to sell.
About the stock market, though, and maybe we should dig into this more next week. I mean, I'm more on the side of your analyst than you. Yes, the stock market is this year it outpaced earnings were up 14% and total return is up 17.5%. That's not rampaging. That if you believe that AI is the next industrial revolution, then corporate profits are going to continue to march higher, and you would expect stocks to continue. Now, could it take a pause? Sure. Could there be when there is a correction, will it accelerate more than, to quote, a fair value? Of course it will. And so yes, you're right. You could see it. We saw it. I mean, I think someone went through, I can't remember who it was, Jordy Visser, I think. On a podcast I was listening to this weekend, said we've had 5 20% corrections in this big bull market. The tariff tantrum this year, others, these happen, right? They do, and they're instructive. And your theory that Bitcoin is going to lead it lower. I mean, the only way Bitcoin drops the way you're talking about is if Bitcoin idiosyncratically is showing signs of failure. It's not Bitcoin.
Well, it's right now. It's 87,000. When we started this conversation, it's around 89.
Yeah, it's in a range.
It's made.
Jane Street entered the chat a little bit early. So,
what'd you say?
Jane Street entered the chat a little bit early.
This funny thing happened. The market opened. That tends to see some volatility at 9:30 a.m. on any given day. Yeah, I would say that we have glaring levels, obviously, as I said, between here and 50,000. I think there's a lot of confusion because there's just mixed data and we don't know what we're going to get. I mean, we didn't really talk about it. We talked about the Fed, but we didn't talk about the fact that we're actually going to get some inflation numbers and job numbers this week that have been delayed effectively since September. Plenty of time for them to cook them. They can change them as much as they want. They've taken a few weeks to do that. But I think that is going, kind of to Mike's point, to show us a lot about what's coming by the end of the week. I don't know if that was the reason you thought that, Mike, or the price action, but we are about to get a lot more.
Part of it is the data, I think, is
on Friday.
Well, I think part of it's the data is completely insignificant. It's about, as we all know, it's about hitting stops. People, I think, just wait for the data. All right, sell. And I think that's what's happening. Just wait for the data. We've already started selling into it. I pointed out Microsoft and NVIDIA and the NASDAQ is potentially double top, actually a lower level double top. Cryptos are hitting top. It's the end of the year. You're not supposed to buy this. You're supposed to wait. And I think it's just accelerates rather than rebounds into the end of the year. And we're doing it now. We opened up, the S&P 500 was up 0.4, up 5 cents last night, E-minis, and now it's down. To me, this is potential beginning of a crash.
It would be an interesting crash. That starts on a Monday with a small down, It could happen. There's no two ways about it. Crashes can happen. I mean, hell, James Wynn was saying that Monday will be Black Monday over the weekend. I mean,
every Monday is Black Monday, according to James Wynn, whose credentials are losing $1 billion on his first leverage trade of all time.
Yeah. So, I mean, look, there is one thing that's going to hurt the stock market next year. You might be right in terms of existing things. And there's one major similarity between 2000 and now, and that is an unprecedented size of IPOs that are going to come in 2026. So that is an interesting one, because it means existing companies are going to get sold in order to buy into Anthropic, XAI, SpaceX, OpenAI. Those are going to be massive. And so you're going to have trillions of market cap for, valuation of IPOs. That 100% is going to put a damper on the valuation of existing stocks. But that is not even remotely negative for the entirety of the stock market cap. And so if it's a question of what do you think Bitcoin and other things are correlated to? Are they correlated to NVIDIA, or are they correlated to the entirety of the stock market? The entirety of the stock market is going to be up when it's all said and done, because all of this new stuff is going to be in there. I mean, it would take one hell of a correction for it not to be up with all of this capital coming into the public markets, but it's mostly moving from private to public. But yes, I think if you look at the existing stocks, that is a major overhead thing they're going to have to deal with. And that is literally the thing that popped the tech bubble in the internet bubble, was because there was a rash of IPOs of companies struggling, just slamming to get out there.
Now, a little bit of the difference is that most of those companies were not ever going to be profitable.
Right. And so there are major differences, and history doesn't repeat, it rhymes, but those are macro factors. But I find there's one thing that's true. If you're right and there's a stock market crash, that won't happen. And right now, a lot of institutional investors are pricing that in. A lot of institutional investors who, the ones who don't have the private stock, are almost certainly have cash reserves to be able to buy into that stuff. And it got pushed back because of the government shutdown. But, so it won't be first quarter, it'll be second quarter, but those are real effects. And we were way over, so I'm sorry.
Yeah, we definitely have to wrap. I just want to ping really quickly a couple stories that we should have talked about, just to show the very clear tailwinds the industry has, whether that ends up reflecting in price. JPMorgan steps further into crypto with tokenized money fund. Ripple, Circle, BitGo et al. 5 companies got basically the license to be trust banking institutions, which is absolutely huge. Maybe Dave will talk about that on Crypto Town Hall. That added to the OCC news that we had last week. Of course, you mentioned SpaceX. That's not related here. 1.5 trillion public listing. But for many who were being skeptical, Michael Saylor did remain in the NASDAQ 100 with strategy and went on to casually buy another billion with a B dollars in Bitcoin this week. That's 2 weeks in a row that he's effectively put in a 10,000 Bitcoin plus purchase when last I checked, it was going to zero, it was going to be delisted, and it was all over for strategy. According to
So I'm going to see him at an event tonight, an economic club event. I really want to see what he has to say, and just strategy's down about 4% this morning.
You know what he's going to tell you? He's going to talk about digital credit. He's not going to talk about MicroStrategy price or Bitcoin, because that's the new narrative. But that's all we got, guys. We're at 10:07. Thank you, gentlemen. Thank you, Mike.
The sun is actually coming up here, so
yeah, we can gauge our overtime by how light it gets in James's room in Vegas.
Yeah, that's funny.
All right, and Dave, we'll see you on Crypto Town Hall in about 7 minutes. All right, everybody.
Yeah, I'll be probably 5 minutes late, but I'll
you and me both. Crypto Town Hall in 12 minutes. All right, see you guys soon. Thanks.
Goodbye.
Everyone's looking for smarter ways to build their Bitcoin stack. Well, here's one most people overlook. You can earn Bitcoin every single time you spend without ever buying it directly. That's where today's video sponsor, Gemini, comes in. The Gemini credit card gives you instant crypto rewards on every purchase, and there's no annual fee. It's a MasterCard World Elite, so you can use it anywhere MasterCard is accepted. Gas, groceries, travel, all of it. Now here's the breakdown. 4% back on gas, rides, and transit. 3% on dining, 2% on groceries, and 1% on everything else. The best part? You're earning Bitcoin or one of 50 plus other cryptocurrencies automatically deposited to your Gemini account. For me, it's been a really effortless way to build exposure to Bitcoin just by spending like normal and doing the things that I do every day. I've literally earned Bitcoin just from filling up my car with gas. And historically, Bitcoin rewards held for 1 year have appreciated 279% on average. You're not just spending, you're building a portfolio. This is the Gemini credit card. Sleek, straightforward, and one of the easiest ways to turn everyday purchases into long-term value. To get started, look at the link in the description and get $200 in Bitcoin when you spend $3,000 in your first 90 days. Click the link in the description to apply and start earning instantly. See rates and fees in the description for more info.